The easing cycle from the Federal Reserve is upon us, and the market is pricing at least 125 basis points of cuts by the end of this year, with the vision of being in around 3% by 2026. 3% interest rates could be the new neutral rates going forward. Now, the US stock market, such as the S&P 500, is approaching all-time highs, and they could be about to break higher if all goes to plan. Now, the statement from the Federal Reserve Chairman is going to be what's important in this upcoming meeting this evening, and there is a strong debate whether you should see a 25 basis points cut or a 50 basis points cut, and it is an interesting one. But I think the context surrounding the cuts will be more crucial. Does the Fed cut and cut aggressively because they can and because it's a win for combating inflation and controlling a cooling labour market? But we also have to remember that the mandate of a central bank is price stability, which is keeping inflation at manageable levels and full employment. However, if they cut rates because they need to protect the labour market and feel that it is fragile, then this could be something that is bearish for US stock markets going forward. Although, what does this tell us about inflation? Is the Fed prioritizing the stock market over inflationary pressures? And if we think about what cuts are, they are inflationary. Why? Because they can influence more credit into the economy. Credit is income for an economy and therefore can create growth in employment and other aspects. So why could the stock markets be in trouble? First, let's discuss the similarities between the market today and in 2007. The price action has been very, very similar, eerily similar. Price rallied before the rate cut and after the market fell into a recession. Now times are different and we don't have all the situation with the banks failing and hedge funds closing, being over leveraged in the US subprime debt crisis. But we're still seeing similar price action. Another interesting chart is one that I found, which includes the SARM rule, which is an indicator that was developed by Claudius Sarm, an economist formerly of the Federal Reserve. And the SARM rule identifies signals related to the start of a recession when the 3-month moving average of the national employment rate rises by 0.5 percentage points or more relative to its low during the previous 12 months. Now, when we combine this indicator with the Fed funds rate and then look at 2007, we have similar correlations to back then. Also, another correlation to think about is with the VIX, or the volatility index. This typically, this time of year or seasonally, does rally around this time of year, and if it did, then that would see equities turn bearish, the Japanese yen and Swiss to become stronger. However, the market will tell us what's really going on. If the S&P 500 prices trade through the all-time highs and hold above them, then it's more likely the market is taking this positively, and I would expect a continuation of the risk on rally. Alternatively, if the price breaks through the highs and then closes back below the lows, I would be interested in seeing some equity downside. Let me know how you think tonight's event's going to go. I'll speak to you in the next video.